Stay with us because we want to bring in senior economics reporter Steve Leisman. He was in the room for Chair Powell's news conference. And Gary and I were talking. We thought you asked a really interesting question about basically whether the Fed chair minded that the stock market is up a lot since the last meeting as he's trying to tighten policy. I'm not sure if you were satisfied with the answer.
Never satisfied with the answer, but very satisfied that both you and Gary thought it was a good question. Look, here's the thing. The stock market, I think, is the least of Powell's problems. I think the bigger problem are the interest rates that I enumerated there earlier. Not to mention, I'm looking right now, Sarah, that the January 24, in other words, the end of the year for next year, is now trading in that 436 area right now, which is, remember, the Fed is at 5.15 for year end. So there's a big gap there. There's going to be some kind of conflict. Let's hear how Powell answered the question about whether or not this loosening of financial conditions represents a problem for him.
I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives.
So he pointed us to the SEP. Let's go to the SEP and let's look at that 2023 outlook there. And you can see right there, 17 folks are above 5%. 5 are at 5.4 and 2 are at 5.63, which, by the way, that goes along there. One of them is out there at 5.63 for a very long time. I'm sorry, that maybe that is inaccurate there. It's just 2 at 5.63, not 12. In any event, the issue is that the Fed is, at least in their thinking, much more hawkish than the market. And maybe Gary or maybe you, Sarah, can explain to me how those twain meet.
Well, doesn't usually the market tell the Fed where to go on that front, Gary?
I don't know.
You know, look, it's an interesting debate, but the market's been more right over the recent years or so. I could also point out the obvious. We could look at where the dot plot was a year ago as we sat here, and we could look at where the market was. The dot plot wasn't anywhere close to right a year ago as we sat here. So if you ask me where I think we're going to be, I think the markets looks much more accurate, as I think we're going to get people back into the labor force. People are going to be forced back into the labor force, and we're going to get wages to settle down to some degree.
So, Gary,
Gary,
you see rate cuts next year?
I'm not sure I see rate cuts at the end of the year.
Because that's what has to happen for the market to be right.
Rate cuts at the end of the year.
That's what has to happen.
Yep. It's possible that we could get rate cuts at the end of the year. It is possible if we get workforce participation back to where I think we may see it. We'll get participation back, and unfortunately, we'll get participation back at a time when we get jobs slowing down as well, which means we will get higher and higher unemployment, which would then lead you to a rate cut towards the end of the year.